I'm Brandon Warnke. I'm a hard money lender with TaliMar Financial. I've been able to do a couple of interviews now with industry experts, but I am super excited to have my buddy and president of TaliMar Financial actually be a co-host with me. Today we're going to talk about the couple of the different sides of hard money lending. We're going to talk about the origination side, which is what I'm mainly focused on. And then we're going to talk about the fund management side, which Brock is out there, constantly raising money for the fund. But so yeah, Brock's main focus right now is to actually raise capital. And I was brought on maybe about 6-7 months ago to go out there and originate loans and put that money to work.
Yeah.
So Brock, can you, again, hey, thanks for joining me. I really appreciate it. Can you tell us a little bit about TaliMar Financial?
Yeah, sure thing. So first off, Brandon, I want to say awesome job on doing these interviews. It's a lot of fun seeing you out there and talking to some of the industry experts. I think you've got some really cool interviews. So appreciate you bringing me on and including me on one of these. So my name is Brock Vandenberg. I run TaliMar Financial. Actually established it back in 2008. Back then, we were funding super short-term loans. Back then, you could actually, most of my investors were buying houses at the foreclosure steps or from bank-owned properties. It's a lot different now, but and essentially what we would do, or I would do, would be to go identify, originate that loan, and then find an individual investor, and then marry the two, and then I would manage that loan on behalf of the investor and the borrower. And then as we grew, we actually launched a mortgage fund, which was essentially the pooling of all of our investor capital into an individual. Imagine like a bank, you're a depositor in a bank, and then the bank goes out and lends that money out. That's essentially what we are today. So our focus is funding short-term residential and commercial loans to real estate investors. So these are all investment properties. I was originating loans all the way up through 2020 or so, and then recently brought Brandon in to assist with doing the loan origination so that I could more focus my time on building the fund and bringing more capital in. So it's exciting to watch Brandon getting out there, bringing loan requests in, and kind of relying on his expertise. So thanks, Brandon, for introducing me. Yeah.
Yeah, my pleasure. And hey, thanks for the keys to the Ferrari over here.
Be careful with it.
Yeah. So yeah, I'm like I said, I'm out there looking for quality, first position loans, specifically in California, to put into the mortgage fund.
Yeah.
I guess a little bit about me, my background. So I've been in hard money for about 2 years now.
Okay.
If you count the time I worked for a hard money lending conference, I actually worked for Pitbull and NPLA conference for a little bit.
Who ran Pitbull?
Yeah, so Leonard Rosen.
Leonard Rosen. So for those that don't know, maybe are on the conference call, there's a lot of conferences out there for hard money lenders. And, some are pretty bland, but some are pretty exciting. They get some really good speakers. And Leonard was, I always chuckled when he got up on stage. He was quite an entertainer.
Yeah.
I don't even know if you would know who I was, but I enjoyed going to his conferences.
Yeah, you're probably right. He doesn't know who you are. No, he knows who you are. He's actually brought you up a couple times. But yeah, it's actually where I first met Brock was back at one of the conferences back in Beverly Hills. So
okay, yeah.
We just briefly connected. Later we connected over at SDCIA, so that's another story. But
what's interesting, so just kind of a side note, I don't know if you know this, but one of the things that really interested me in bringing you on board was that you did have like this huge perspective or saw all the hard money lenders out there in the industry and kind of had a kind of an insight into how a lot of these organizations ran their origination platforms.
Yeah, and that kind of perfect segue into like kind of different types of hard money lenders. So yeah, in my book, there's 3 main like types of hard money lenders. There's one which is or just lenders in general, besides conventional. You have your private money lenders, which is somebody that you know more on a personal basis. This could
Yeah.
be friend or family member, rich uncle, or a high net worth individual that you have a close connection with. Um, those terms are a little bit pretty favorable, maybe lower, super low interest rate, and like I guess like really, really common sense underwriting, like practically no
I would
under.
say it's kind of like, hey, they trust you more than the deal. They
Yeah,
understand the deal itself. It's
that's
they have,
purely relationship based, and it's
yeah,
more like on a
yeah,
kind of handshake, and there's going to be some sort of documentation as well. Then
yeah.
you have your uh, institutional guys.
Mhm.
You have lenders that are much bigger, that are probably backed by, well, they are backed by maybe like a hedge fund or some sort of institutional capital. Once they fund that loan, then they need to sell it on the secondary market.
Mhm.
Then you have guys like us.
And that's new. So understand, Brandon, like the idea that you could take hard money loans and sell them into the secondary market. I mean, that concept didn't happen until, mid, 2012, 2013, where you actually started to see people selling these loans. They kind of took the idea from what you did on the conventional side and started doing it on the hard money lending side.
Yeah, before I got into hard money, I mean, I know that's how conventional works, but I had
Yep.
no idea that these loans were needed to be sold off to the secondary
Yep.
market, which, like, if you're out there originating for a lender that cannot hold a loan on the books,
Mhm.
and they need to get it into that secondary market, and then the secondary market stops buying, it can be really hard for an originator to build a relationship with the customer if
Yeah.
something's changing at the end, and you're telling them like you can't fund a deal. So yeah, that's something I definitely came across. And the last type of hard money lender is guys sort of like us, which are we have a backed by like a small or medium size, I think now,
Mhm.
mortgage fund. I think TaliMar is up to like 57 million.
Yeah.
So
We're
good,
chopping on 60 million right now in total capital.
yeah, and good job to go out there raising the
Yeah, yeah.
raising the
Well,
funds.
you keep bringing in good loans, I can keep
Yeah.
bringing in the investors.
Um, but yeah, so the underwriting for our type of setup is more kind of streamlined. It's more common sense underwriting. Um, yeah, we make it a lot. I feel like we
I
make it a lot
always, I
easier.
always tell people it's like the best of both worlds. You've got from a private lending side, you can really kind of look at the operator, your investor, your borrower, who is it, who are we actually lending to, get comfortable with them without really being boxed into some really heavy underwriting criteria, which I think, institutional has a ton of money, but you really have to be within that box versus then you've got the capital behind you. So, if you're reliant on a small private lender, which is great if you've got that relationship, but they typically don't have a deep pocket of funds, which a mortgage fund would have or an institutional capital partner would have.
Yeah, right. And
I mean,
so
what do you? I mean, you've done it on all sides. I mean, you've originated loans for private investors, for a fund like ours, and on the institutional side. I mean, you see benefits on both sides.
yeah, I mean the benefits of having being backed by a mortgage fund is it just makes everything a whole lot easier.
Mhm.
Like I have direct access to you, which is the capital, and
Mhm.
we it's I like to say we have complete control over the push to fund button. All I got
Yeah,
to do is get a quick loan application, fill out a pro forma, and then it's literally like a yes or no within, I don't know, 24 hours. I don't have to
yeah.
submit 20 questions just to get a term sheet out.
So tell me this. So, like, I've been kind of out of the origination game for a while. How many loan requests are you getting a day now?
These days, the market here is heating up. It's been
Yeah,
about 5 to 7 calls a day, at
five
least.
a day.
Yep. Yeah.
So okay, so that all right. I was thinking I'm like 2 to 3 calls maybe back in the day that I was getting. How do you get through? How do you get through all those calls? I mean, how do you quickly analyze and say, hey, this is going to work or this isn't going to work?
Yeah. So the first thing I look for is if the first words out of the mouth is like, this one's got some hair on it, or this one's a little bit tricky, yeah, probably, not, it's not going to be a fit for us. But what I'm
Yeah.
mainly looking for is kind of something I took from Pitbull conference, that 19 words or less. Like they used to tell me that if you can't explain a deal within 19 words or less, chances are, there's probably not a deal there. So
Yeah.
what I'm looking for is a quick.
I always call it like, if you can't explain the deal in 30 seconds and
Yeah.
you're in your explanation, it goes, I know this, but trust me, it's going to work this way, or
Yeah.
it looks like this, or really, I could always tell.
Yeah. So what I'm looking for is like a quick, high level executive summary, 30 seconds. Also wanted to see, I'm looking to hear the confidence in their voice.
Yeah.
And that tells me that if it's a broker, that tells me that they have control over the scenario. And if it's a individual investor, then it just tells me like their overall confidence, their project. And then I am looking for just get a general experience that they have with hard money. Have they used it before? Is this their first time? And then their experience in real estate in general, like how many flips.
So for example, like how many fix and flip loans do you think you're originating? Like generally between bridge loans, which we consider loans where the borrower isn't adding value to the property, it's just a purchase loan or maybe a refinance loan, versus a fix and flip loan where they're adding value. What from a fix and flip standpoint, what are you asking right off the bat?
From right off the bat, I'm asking them kind of what their expectations are. Are they looking for 100% financing? Because that's obviously not something that we offer. It also tells me that they may not have the funds to make the monthly payments. So what I'm looking for is just back to their experience. How many like fix and flips or bridge loans have they done in the last 2 years? I want to know if they have like a budget and a scope of work laid out. If they don't have that sort of at the ready, that kind of tells me they're winging it, and they don't really know what.
It's funny. I used to ask right off the bat, go like, hey, what's your purchase price? Because it would already tell me, number one, did they know the purchase price? Number two, did they have it under contract? Because if they didn't have it under contract, then it would say, okay, well, we're trying to get to a certain, to a certain.
I just assume everybody that calls me has something under contract, but these days that's kind of how it's been. And then
obviously the rehab, I go into like, hey, tell me about the, what is the rehab cost? Because that would right away, that would tell me, okay, they understood the budget and that they could, that they understood what the scope of work was.
Yeah. So once they get that, I want to know what their exit strategy is. I want to know like how they plan to pay off this loan.
Yeah. And then the ARV was the other one. Like I would always use the ARV. Hey, do you really know what the value is? And
is that a realistic ARV? So some guys have they think their project's gonna be worth 2 million, being worth 1.2. So
I'll tell you what though, I had some of my best clients would come in with ARVs that were really not achievable. But if I always found that if you were just honest with telling them like, hey, I know you think it's this, but based upon the numbers that I see in the marketplace of properties that actually sold, you would actually gain a client. I mean, that deal may not work, but they're very much more apt to bring you another loan request because they know you're going to be honest. You're not just there to close a loan with them.
Yeah, absolutely. I mean, always looking to be honest with a client, because the last thing like I want to do is fund a bad loan.
Yeah.
I don't want to be like, oh yeah, you're gonna make a ton of money when I know that you're really not gonna like barely break even. I'm gonna definitely let you know.
Yeah. How many so nowadays, again, when I was doing this, there were a lot on the origination side. I'd say maybe 20% of the transactions on the fix and flip side would come through wholesalers. Is that still the case? And you may want to explain, what is a wholesaler?
Yeah. So lately I've been getting a lot of referrals from wholesalers just because they know we can close, super fast. Like, and they know how our process works, and I know how their process works.
So these wholesalers, the people that they go out and look for deals. They look for these fix and flips, lock them up, and then sell those off to the actual end investor.
Yeah,
right.
They go
Okay.
get them under contract. They usually have a specific time to assign it to, me if I'm the buyer. So
okay. And then why are the wholesalers bringing the borrower to you though?
Because a lot of sellers need to close in 2 weeks or less, where conventional funding can take up to a month.
Mm-hmm.
Sometimes, yes, you can get quicker conventional, but
but in terms of like, if I'm a wholesaler, why would I want to bring it to you, Brandon, or my client who's buying the property from me as a wholesaler to you?
Because we're going to close the loan.
Okay. Yeah.
I mean, if you have a high debt to income ratio, you're not going to be able to get conventional financing, especially if this is like your second or third investment property. Yeah. So that's where guys like us come in, where we don't look at debt to income. We're looking more on the asset and the equity that's in the asset, and if it's a fix and flip, we're looking at the future value. Okay. So that's why wholesalers, and we're able to fund that. If the property needs renovation, we're able to fund that renovation as well. Okay. That's all wrapped into a loan, which you have like super easy access to.
Now, what percentage of your loans now are brokered? So you got an actual third party broker bringing that loan request to you. And what are those type of deals look like?
So brokers, we don't get a lot of fix and flip requests from brokers, just because a savvy borrower, all they have to do is Google, hard money lender. Yeah. And obviously TaliMar is going to probably be the first option. They're going to call us.
but in terms of like what type of deals then are they bringing?
Yeah. So brokers are mainly focused on bridge loans. So something that is turnkey, that they maybe want to get under. If the seller wants to close fast, like on the listing, you'll see at the bottom, cash or hard money only. Yeah. We're the hard money guys, obviously. So that's where we can come in. It's a cash equivalent, where we can don't need an appraisal, close in 5 to 7 days. That gives the borrower the time to acquire the property. And then if they plan to hold it, then they would get that property stabilized. That way they can get a better rate on the takeout, which would be called like a long-term financing.
I'd say that I used to get a lot of bridge loans from brokers that they needed either the conventional lender couldn't close on time, or it didn't pass underwriting, but they still had to close on the property. So they would come to us for like a short-term loan. I remember one we did it was actually a commercial property, an auto body shop that I think it was like a $2.5 million first that we came in and funded, because they were actually refinancing the loan with another conventional lender. They're existing, they had a private lender on it, and that conventional couldn't close. So they just brought us in as like a short-term band-aid while they could finish out the underwriting with the other conventional lender.
Yeah, that's a common scenario as well, like bank fallouts.
1031 exchanges. I was always going out and getting 1031 exchanges were a commonplace too, where maybe they're selling one, they need to close quickly because they're going to lose the 1031 tax savings. So they would fund it and then take us out with a conventional loan. Yeah.
And then we just got one the other day for reverse 1031 exchange. So.
Oh, that's right. Yes. I did one of those, the reverse 1031 exchange.
You think you know it all until you get the reverse 1031 exchange.
Yeah. Yeah.
So, but yes, so I think we covered a good amount of like kind of what I'm looking for in a loan, and what I'm looking for when I'm talking to a broker and a borrower. Maybe can you tell us a little bit about like how do you manage a debt fund? Like, did you always have the fund, or tell us a little bit about what it was before the fund? I'm just curious.
So as I mentioned,
a lot of people know about trust deed investors.
Yeah. So essentially what a trusted investor is, or what we would do is we would take let's call it a fix and flip loan. And then we would underwrite it, approve it internally. And then I would have, a bucket of investors that would invest in that loan. So that's what a trust deed investment is. We talked about, working with private lenders, right? That's kind of the equivalent somewhat of a private lender. It's just that I had thousands of private lenders that would invest in the loans. So like I said, we got up to about 50 million in terms of loans from private investors. So we had a lot of access to individual investors. But when you talk about building volume and trying to grow your, this platform, trying to rely on individual investors, it became too complicated. So, if you're a loan originator, Brandon, and you came and said, hey, Brock, I've got this loan teed up, we're ready to close on it. And you're hearing, well, Brock, I got to, Brandon, I got to go find my trusted investor to invest in your loan. I think you lose a little confidence there. Yeah. And so you're sitting there, twiddling your thumbs. And that's why we decided, okay, we have all these investors. Let's go ahead and launch a fund. Let's just consolidate all that investor capital so that, we feel confident with loan officers, when they bring the loans in and get them approved, that we can just say, okay, give them the green light and we can fund that loan. It's a much more efficient process to fund and manage hard money loans within a fund than it is, piecemealing all the loans with individual investors.
And then quick question, like turn time to fund with trusted investors, was it?
We got it down pretty well. So, if you brought a loan to me, I could have that funded within 24 hours. Yeah, I would say that, we really had it dialed in, but it was like, I knew my investors, I knew what they were looking for. They're confident in what we were bringing to them. However, there became a point, that again, we were growing so big or so fast, and we were bringing so much loan volume in. You started to run out of trusted investors that you could go to with your loans. So I always tell, we have these in our conversations in our meetings, is that like when you run a debt fund and you have loan origination, it's like two separate companies running at the same time, but they're always having to balance out. So I got to have the right amount of capital available for you to be able to fund your loan volume, so that when you come to me and say, hey, Brock, I'm ready to close on this fix and flip loan, that I've got the capital within the fund. But the nice thing about having the fund is that, and I'm kind of going into the weeds here, is that you can leverage the fund. So now I've got, roughly 60 million in loans in our fund. I can lend against that. So if you bring in and say, hey, Brock, I've got a, $1.5 million loan request in Coronado. Do you have access? Do you have availability in the fund? Well, I may not have the capital, but I can borrow against the fund your loan, and then pay down that leverage with future payoffs or new investor capital that comes in. So that's what we do on the fund side, to making sure that we have the capital available for you to originate your loans.
Yeah, and this is kind of getting into the weeds, but this is has to do with on the back end where there's wholesale companies that offer wholesale lines of credit, right?
Yeah.
And stuff like
that. So yeah, there's wholesale lines of credit
that you can beast is the wholesale.
Yeah. And this is where the institutional guys will come in. So, they can look at your portfolio and say, hey, TaliMar, we want to buy a quarter of your portfolio of loans, here, and then you could sell them off. That creates a little more liquidity for us to fund loans in the future. The downside to doing that, though, is that now you've lost control of those loans. They're owned by another institutional partner, and they may have, if it's on a fix and flip loan, they may have their own process of doing draws. Like, one of the big things that we like to say is that we can release your draw within 24 hours. We make it super easy. We're not sending out a third party to go review the draw. We can do it all in-house and have funds out the next day. A lot of these capital partners, and they're required to have a third party go out and review the draw request. They want to make sure their loan is secure, that the draws are being done appropriately, and that kind of slows down the process. So that's why the fund structure, I think, is kind of an ideal mix between private funds, right? Because we've got way more capital in the private funds, but more flexible than what the institutional guys might have.
Right.
And that it goes to your underwriting too. I mean, you bring in some crazy loan requests, and I don't think, and I make a joke here, is I don't think a loan originator has the ability to say no.
Right. I know that's definitely a skill you have to develop.
It's like, no, this is not going to work.
Like,
But you know,
maybe it'll work. But you have to learn. You have to learn. It takes time to learn how to say no to potential deal. I mean, we want to fund everything, but again, I got to go back to quality loans to put the money in the fund to work.
So what I mean, like, when you say quality, what do you consider quality loans?
Quality to me is something that's in a core urban area.
Yeah.
The borrower has, good credit, like 75, 700 plus. And then, a strong exit strategy. But it's really, I mean, to me, it's more like location and their ability to make the monthly payments.
Yeah.
Yeah.
Yeah. And I appreciate you take that, because I take a more conservative approach to underwriting loan requests. There's, number one, people think hard money, and they think, okay, well, it's just based on loan to value. You're at 40%, and this is a common thread I get, or a common response I get from brokers is, well, you're at 40%, you're perfectly safe. Well, I consider myself more like a bank in terms of, I don't want non-performing loans on my balance sheet. It's not. It hurts me raising capital, because investors ask, hey, how many non-performing loans do you have in your portfolio? And you always want to say zero. Number two, it's very costly and timely to foreclose on a property. And I don't care how much equity there is in there. It's just not worth the time and effort to have to foreclose. So I always say, when I look at loan requests or loans that come into our portfolios, number one is going to be borrower credit. It's such a great predictor of if a borrower is going to perform or not. And that's why we always talk about this, Brandon, like bailout loans. I just don't like bailout loans. Borrower going into bankruptcy or just coming out of bankruptcy. Again, it's not something, I'm not saying it's a bad loan. It's just not for us. We want to see a clear exit. How is this borrower going to make the payments? Show me they can make the payments. And then how are they going to refinance me out of this loan? So, that's why I like the fix and flip loans, because you kind of our exits are aligned. I know exactly how they're going to pay me back, and that's the sale of the property, and that is what they're trying to do. Versus, a borrower that may come in and say, well, I don't have the greatest credit, I'm going to build my credit up and then refinance us out. And I find it's, historically, if they don't have great credit, I guarantee you, unless something happened that was an immediate, knock on their credit, they're probably not going to be rebuilding their credit with you as the lender. So, that's how I run my debt fund. And I think that's why we can raise capital to do more loans like you. And actually, a question came in here. It says, how does TaliMar handle if an investor wants out of the fund? Okay, yeah, so this is more of an investor question in the fund. So what we do is we'll go ahead and process your withdrawal request. And usually we can process, depending upon the size of the withdrawal, usually within a week or two. If it's larger, it's going to take a little longer, but the fund is relatively liquid. So we're constantly having loans turn over in the portfolio. So if a loan pays off, we'll go ahead and put aside the funds for that withdrawal request for that investor from the funds of the payoff, or if there's new investor capital coming in, and then distribute those funds back to the investor. I think the average withdrawal request we've had range from 50,000 all the way up to $1.5 million. And I think it took us about 30 days, maybe a little over 30 days, to get $1.5 million out of the fund. So hopefully that answers your question.
Is there a time limit that you have to get the money back to the borrower?
Yeah, technically we have up to
6 months to get it back. Do you have 3 months, 90 days?
Yeah, typically you have about 3 months to get to handle investor withdrawals, and that that shouldn't be that hard to make the 3-month requirement. But as a fund manager, I always say it isn't the bad loans that I mean, it kind of is, but it's not the fact that you have a bad loan in your portfolio. It's when a huge amount of investors come in and try to withdraw funds all at the same time, a run on the fund, kind of similar to a run on the bank, that's where it gets, it's a hurdle. It becomes a problem for a mortgage fund, because then you're not making decisions based upon quality of loans. You're making a decision because all your investors want out of the fund. And now you're having to sell loans, and most likely you're going to have to sell them at a discount just to meet the withdrawal requests of the fund. So that's kind of more of the in the weeds of being a fund manager.
It's interesting to just kind of know this kind of stuff, because I mean, I'm out there, I do a lot of networking around San Diego, and now I'm seeing a lot of, these funds kind of pop up. So some of them you have to be accredited, which means that you have to have a $1 million net worth excluding your primary, or consistently make $250 a year. So there's some funds that require you to be accredited. There's some that just require you to be sophisticated. But there's a lot of funds popping up around San Diego. So if people are like kind of like, oh, I'm not accredited, but I'm sophisticated, and they feel like dumping some money into these funds because they're promising a good return, just make sure, you're looking at the fine print, like how do you get money back, stuff like that. I'm just curious. So it seems that anybody can be a fund manager. Is that true, Brock? Like, can anybody be a fund manager? Like, how difficult?
I mean, technically anybody can be a fund manager. And this is, this is where it's a learning guide for me. So I've always came from the loan origination side where I was originating loans. And I think there's a question with a hand up. If you want to go ahead and just type in your question, I think that's how that works. So type in your question under the Q&A and we'll be able to answer that for you. I've always been on the origination side. I love the origination side. I love kind of working through deals and finding solutions. But, as you grow your fund, you can't be out on the street looking for loans all the time. And so, you find that like you got to designate certain responsibilities to different people. Now, when you start a fund, it's really difficult unless you have an incoming amount of loans or a large amount of investor capital right off the bat to really be successful in launching a fund. Because, for us, we were lucky. We already had deal volume coming in because I had been running the trustee platform, and I already had access to all this investor capital who I had been working with for a decade before on matching our existing loans to that investor capital. So for me, it was just the progression. It was the way you would take the next step into running a hard money lending company, being that I already had the incoming loans and I had the availability of capital. This, by moving into more of a fund structure, it allowed me to just scale. It allows me to get bigger, do more loans, and be more of a resource to mortgage brokers and real estate investors.
So tips for guys like looking to start a fund would be to maybe start off brokering some loans.
Yeah, I would highly recommend. So if you're a mortgage broker out there, or maybe you're originating conventional stuff, or you're looking to get in the industry, I would highly recommend your first step is more brokering loans. So, you get a loan request in, you don't know if it's going to work or not, give Brandon a call, run the scenario, by him. Brandon, you're taking 5 to 7 calls a day, and you know what questions to ask. Send that broker back with the questions they need to ask, and then get that loan under control. And then you get a couple of those under your belt. And I honestly think that a lot, and I always say they go to the dark side. I think there's so much opportunity for mortgage brokers, loan originators who do on the conventional side to get into the hard money lending side. We have not been busier. I've never been busier in terms of loan volume ever. And the reason being is, number one, the small and kind of regional sized banks who typically would fill this need, this real estate financing need, have all pulled back on the lending. And so where they would have done the financing, a lot of these investors and brokers have to go to the private lending side, and they're coming to companies like ours to get that financing. So, if you understand the hard money lending business, you understand what questions to ask and what fund managers like myself are looking to fund, you can do really, really well originating hard money loan requests.
Yeah.
And what's nice about it too is, a lot of these investors are constantly doing deals. So if you get a good client, they may bring 4, 5, 6 loan requests to you.
Yeah. I mean, before you know it, you're going to be like into this stream of investors,
Yeah.
and you're going to have a really good relationship with your hard money like account executive.
Yep.
And then, the good thing about working with investors is that I like to call them like say that they're buttoned up.
Yep.
There's not a lot of back and forth. Like I don't need to consult my husband, consult my wife, about this monthly payment.
Yep. Yep.
Investors know what they want and they
Yeah.
have their
And they
documents.
know what to expect. That's what I
Right.
always
You
say.
know
They
what to
know
expect.
they know
Exactly.
hard money loans are going to be more expensive, and there's really no other option they have. They're not going to be able to get that loan from a bank. They know they have to go there, and usually these things close within a week to 2 weeks.
Yeah.
So
So
you can get paid pretty quick.
definitely, yeah, you definitely can get paid really quick. That's the
So
whole
a
thing.
question comes in, what's the average annual return for with a $50,000 capital with your company? Right now, our target yield currently is about 8.75% to 9%. I think this month that's annualized. This month we had an annualized yield of about 8.9%. So you'd be earning about 8.9, almost 9% on your capital. Now, we structured our fund a little differently. We are a real estate investment trust, a REIT. So as a result, you do qualify as an investor in our fund to earn what's called a 20% qualified business income tax deduction called QBIT. So you're actually only paying 80 taxes on 80% of that income. And then the other thing I always tell people is that we just got approved on the Charles Schwab and Fidelity platform. So if you're using retirement funds to invest, you don't necessarily need to go through a self-directed IRA custodian to invest. You can go through your Schwab or Fidelity account to invest, and that's for retirement and non-retirement funds.
Yeah, that's a really good point. Because I see we work with, obviously we work with real estate investors, but a lot of our investors are working with people that record second trust deeds.
Yep.
So what that means is that the the borrower is finding somebody to come up with that 20% down payment, and they're recording a second lien behind our lien.
Okay.
So some of those second trust deeds, the people that are funding those, they're more risk. And the I see it. What do you see like rate wise out there for second trustees?
Good question. I don't know
And
because the market's adjusted. I used to broker some seconds when back in the day when we do individual trustees. I don't anymore. But if you asked me like 2 years ago, you're probably paying in the 10 to 12% range for a second. I have to imagine seconds now are in the 13 to 15% range, probably higher, and based upon what marketplace you're in. But yeah, we see, that's a big question that we get, or you ask me a lot, is that, on our fix and flip loans, if that borrower, if our client, a borrower brings in an equity partner and they want to record a second behind our first, are we okay with that? And the answer is yes, I'm okay with a second. And I look at it as just an additional body that's going to want to make the payment and keep me current on my loan. Instead of just having one, now you got two parties that want to make sure that the loan is current.
yeah, more guarantors the better,
Yeah.
right? All right. Yeah, the reason I bring that up is because I swear I've seen one for like 10, 11%, maybe a couple of months ago. And then
Okay.
you have the mortgage fund, you're getting like close to 9%. And I
Mhm.
feel like for me, like I feel like because my goal is to become accredited and eventually invest in the fund.
Yeah.
I feel like investing in a fund like this, it's a lot less risk.
Mhm.
If you're investing in a second, and your loan can get wiped out.
So I got a question for you. Kind of change. We're going to change a little tack here. Is that you're out there, Rich? Like I haven't done it in a while, but you're out there, hitting the pavement, going to some of these networking events. If you're a mortgage broker looking to break into the conventional world, what recommendations or tips would you have for a mortgage broker out there that may want to start originating loans and bringing it to people like yourself?
Yeah, so main tip would be to obviously jump on a call and just kind of talk through like how you like your how you run your business as a broker. You want to establish a relationship with your lender, and just kind of learn their guidelines, like kind of
Yeah.
what areas they like, what property types they like, whether it be commercial, residential, you know,
Yeah,
some.
you're right. And that's a good point we didn't bring up because, for me, I'm not a big fan of funding office buildings right now. I mean, that's pretty
Yeah,
obvious.
yeah,
But I don't do land. I don't do, there's hard money lenders out there that will hit those product types.
yeah. So you just want to like kind of set expectations between you and your lender.
Yeah.
Because the last thing you want to do is, tell a borrower you can fund a deal and then, first call like to me is like, oh, do you do land? And be like, in Ocotillo Wells? Like, no, unfortunately, that's not going to be a good fit. So yeah, you just want to kind of go over the loans that are like, if you're a broker, like the type of loans that are coming across your desk, and then you want to just, discuss a couple potential scenarios and be like, hey,
Yeah.
is something that, TaliMar or a fund like yours would want
And
to.
then so once they get this kind of understand the credit box, right?
Right.
What would be your next suggestion?
Next suggestion would be I mean, you're going to be talking to your borrower and seeing that they're funding an entity. You want to see how they're going to repay the loan.
Yeah.
And then you want to get a sense of their credit score, which I think we just talked about.
Yeah.
And, if it's a fix and flip, you want to get a hold of their budget, scope of work, and just their general experience, whether or not they've done a project with rehab before. And then their exit strategy. Are they going to hold it and keep as a rental? Or are they gonna, sell it?
Yeah.
I guess a good thing to note is leverage for if they're gonna hold it. The last thing you want is to be over leveraged on something, because a lot of those long-term takeout loans, the DSCR, they only go up to 75% of the current value.
Yeah.
So
One of the things I always would tell brokers that were like interested in getting in a hard money space too, number one is, understand the credit box. Number two, you really got to get out there and market yourself, to talk to your, current client base. Now, many of them may not be investors, but, talk to those investors and say, hey, how do you get your hard money loans right now? Because, I might be an option for you. And then number three, going to networking events, right? I mean, this is something we always talk about, that, get out there and start to shake hands and meet people. You never know. In fact, we just closing today, a loan for an investor that you met at SDCIA.
Yeah. Yeah. We just closed one.
Congratulations.
One today. Yeah. Maybe
So to walk me through that scenario, like what happened to get that from when you initially met him to when you closed a loan today? I'm actually watching the message right now popping up that we're funding it. So congratulations on that closing.
Yeah, thank you. Thank you. Yeah. So that kind of went down pretty, like, I like to say, like, it just flowed from kind of start to finish. We met at one of the SDCIA beer nights. So we just started, introduced myself, as a hard money lender. Just kind of told him, he's like, oh, I work on, high-rise buildings downtown. So I'm like, oh, okay, and he's like, oh, I used to do flips. And I'm like, well, why not get started? It's super easy to get set up with TaliMar.
Yeah.
Next thing I know, I was talking about, we have what's called the preferred borrower account program.
Okay.
And
once
you get signed up with that, that gives like you the power to request proof of funds.
Okay.
A letter of credit. So you can get a property specific.
And just so people know, what is a proof of funds letter?
Yeah, proof of funds shows that you have you fulfill the necessary requirements to come in with the
get financing
and the closing costs to get financing.
Okay.
So you submit that to a seller, and it just makes your offer, a lot stronger.
Okay. We've had a lot of success. I rolled that program out like 3 years ago, this preferred borrower account program, to issue that POF letter. And I always thought it was, it would, when a potential seller or, the selling agent saw this letter, I didn't know if it was going to work or not, but it's been successful for you issuing those proof of funds letters.
Yeah, no, it's probably our best tool that we have. Because right on there, it says no appraisal required, close in 5 to 7 days, everything a seller wants to see.
Yeah.
you know?
So
So
you issued this proof of funds letter to him.
yeah, so he was actually out there on the hunt. I actually introduced him to a couple of wholesalers that I know
Okay.
through networking. And last thing before you know it, he's under contract. So
On a property, was this through a wholesaler?
this one was not through a wholesaler, but it was
Okay.
for it was through like an investor agent.
Okay.
He had a buyer's agent, and they
Okay.
were out there writing offers. So they would always tag me on when they submitted an offer. That
Okay.
kind of like I could keep an eye on it,
Okay.
each offer. So man, I would log into my email like every other day. It'd be like five emails, with offers submitted. Oh man, these guys are gonna get one of these days. When they're gonna get one. So
It's a numbers game.
it's a numbers game. So if you don't ask like or submit an offer, it's an automatic no. So like
Yeah.
what do you
Yeah.
have
Yeah.
to lose? So they
Yeah.
kept just submitting offers, one hit, and next thing you know, escrow's open. And since he had a borrower account already with us, I already had his entity docs. Um,
Yeah. Oh, so you got to
everything-
streamline the whole
yeah,
account,
everything
the
was
approval
streamlined.
process.
I had my borrower already underwritten,
Yeah.
so all we had to do was, do a quick internal evaluation on the property, underwrite the property, get a budget, scope of work, and
Yeah.
boom, next thing you know, final review and send them the clear to close.
Wow. Congratulations.
Yeah, that's really
You got to do some video content down there. Now you got to go into you got to show everybody kind of what the house looked like beforehand and then what it's going to look like after.
Yeah, that's coming up next. So
Okay.
stay tuned. What else?
All
Any
right.
questions? No questions?
Yeah. So yeah, I think you kind of covered it. I did want to say that go back to this idea of, breaking into the hard money lending industry as a loan officer. I mean, you've been at it now for a while. Talk about tips of getting out there and networking at these networking events. Are there certain networking events that you like going to here in San Diego?
Yeah, so I absolutely love SDCIA, San
Okay.
Diego Creative Investors Association.
Okay.
And that one's actually down in Mission Beach. It's every second Tuesday of the month. You can always message me. I'll shoot you the link.
Yeah.
Another one I really like is called Brew RE.
Yeah. It's because there's beer there.
Because there's beer there. Yeah. That one, it's every third Wednesday of the month. So it's actually tomorrow.
Okay.
And that one's pure networking. So the good thing about SDCIA is there's always a guest speaker at the end. So you actually get to learn something.
Mhm.
And that one, it's more educational. Whereas brewery is strictly networking and building relationships and having a beer and that kind of talking shop. There's some other ones that are starting to pop up, but those are two of my favorites. And
Okay.
a good idea for people to get out there is, find a new event. Try to sponsor it.
Yeah.
Try to sponsor it. I mean, it's believe it or not, it's really not that expensive to sponsor some of these smaller ones. And
Yeah.
next
we get a lot of requests all the time, and I find the best thing you can do is put yourself in a situation to educate people, and not from a sales perspective, but just like educate people on, hey, how do you get into fix and flipping? Like if there's a lot of opportunity out there, but how do you get started? Like on the broker side, one thing we've been talking about is how to educate loan officers and whatnot to start to originate hard money loans, because it's crazy. I tell people that when you originate conventional loans, it's very different than hard money loans. I don't even know the lingo on the conventional side if people were to ask me. And I think it's the same thing on the hard money lending side. Is kind of it's a different language almost.
Yeah. Yeah. Do you even know what TILA and RESPA is?
Yeah, I don't.
All the conventional
But yeah, so that's is the education thing. And I know you're doing a great job on doing these webinars and educating just the general public about who you are and what you do, and how to engage in this industry. So thank you.
Yeah, and I appreciate the push. So I mean,
So Brandon, how do people get a hold of you? We always got to end that one that way.
Yeah, so you can get a hold of me through my email, which is bwarnke@talimarfinancial.com, or my crazy Instagram handle, which is at Brandon from TaliMar. So
I got to get on that. I got to get tell people to contact me through my Instagram handle. I haven't got that far.
I think I have more followers than you now, so you have to step it up.
Well, awesome. Well, hey, Brandon, I want to say, number one, thanks for having me on today. It was a great conversation with you. And number two, congratulations on your closing today, man.
Yeah, thank you, sir. Thank you, buddy.
Yeah.
It all comes down to the TaliMar team, and it's all about the people. You got to have good people that you work with, and that support you. So
yeah.
Yeah.
No, I mean, it like I said, from an educational standpoint, education as we grow organization, giving you the resources you need to be successful, to grow your business, your brand. I mean, at the end of the day, it's you. People are relying on you to close. So, we've been building the back office here so that we can, close quicker, give you better answers quicker, and give you the access to capital that you need to continue to build your business.
Yeah.
So thanks very much, man.
Yeah. So I think that's
a couple
it.
last minute questions coming in. Hopefully I responded. If anybody has any other questions for Brandon or me, we'll stick around for a minute or two and to answer those for you.
Yeah, and this will be recorded and saved on our YouTube.
Yeah, we'll put that up on YouTube and we'll put some clips out there.
Probably.
So Brandon, remind me again, what's the next networking event you're going to?
It's actually tomorrow. It's
okay.
Brewery tomorrow. So
okay. Where's Brewery?
It's going to be an AC lounge over in North Park.
Okay.
So
that's a good one. I like that. That's a good location.
Yeah, it's a good one. The parking, as we know, in North Park is exceptional. So all those ADU builds, everybody's out there trying to build 14 ADUs in their backyard.
Yeah.
No, there's already not enough parking in North Park. Now there's going to be
even less.
So
okay. Well, cool. All right. Well, looks like that's going to be all the questions we've got today. So,
all right.
Hey, thanks very much for everybody listening. Thanks for including me.
Have a good one.
Bye-bye.